I'd like to begin the presentation with a quick disclaimer. This presentation contains proprietary calculations and is the property of JC Realty Denver, LLC. JC Realty Denver, LLC is pleased to provide more accurate computations upon further consultation. The document was prepared using estimates and should not be considered a basis for actual cash flow expectations and/or tax calculations or liabilities. So, starting out with some of the assumptions that are built into the model, you can modify these for your own specific circumstances, but this first component we'd like to speak about is the monthly rental gross income you expect to receive on the subject property. This number, if you are not sure on what to put in here, you could check out a website that I find useful. It's Zilpy, ZILPY.com. There you can type in your property address and a couple parameters about the property, bedrooms and bathrooms, and it will tell you, based on your area, what you could expect to get in rent. I actually find that pretty accurate from what I've seen. You could also check out Craigslist or just drive around your neighborhood and see what people are expecting for rent in the local area. In this portion of the assumptions, we're adding in some considerations as it relates to the mortgage that is on the property that you're considering whether you should rent or sell. We're also considering the annual home insurance and property taxes, which is generally included as an escrow amount of your mortgage if you have one. So in this situation, if you do not have a mortgage on the home that you're thinking of renting or selling, then most of these numbers will be zero, except the home insurance policy premium and the property taxes portion. So walking through some of the assumptions in our example here, we're assuming that the current mortgage principal balance on this property is $200,000. It's a 5% APR 30-year mortgage. The principal and interest portion of the mortgage per month is $1,075. The annual home insurance and property taxes amount to $3,000. Generally, once again, that will be included in your escrow within your mortgage payment. So you may eliminate this line and add to the principal and interest on mortgage to include that escrow amount if you see fit. And the annual mortgage interest amount on this property is $10,000 for the year under consideration. And you can calculate that amount based on a Bankrate.com analysis of the amortization schedule and where you are within your current mortgage. This $10,000 assumes that, of course, this mortgage is pretty young. You're in the first few years, so most of the amount that you're paying into the mortgage is going to be interest. And also the last assumption that's built into the model for this example is a sales price of $250,000. So although this person has a $200,000 current mortgage balance, we're saying that their home would actually sell for $250,000. For your personal situation, probably the best way to find out that number is to contact a real estate agent in your area and have them run what's called a comparable market analysis. That's going to tell you what your property may sell at based on generally what the real estate agent is going to look at is the past 6 months of sales for comparable properties. They may also look at what's available on the market right now and see kind of where the market's moving. But you want to contact a real estate agent to figure out what that sales price may be. On this slide of the presentation, we're looking at the model itself, and we're looking specifically at the rent cash flow in this scenario. The first line is the annual gross monthly rental income. So this is the $1,500 per month rental income we had in our assumption times 12. Most landlords would tell you that that's kind of optimistic because you're probably going to experience a certain amount of vacancy throughout the year, whether it's between tenants or cleaning up after one tenant leaves, or if any damage was done to the property, or even if you just have troubles renting it out. Sometimes it's difficult to find someone that can move in the next day if someone moves out and doesn't give you notice or that sort of thing. So that $18,000 is probably an optimistic number in this scenario. The first subtraction from the gross rental income is the annual principal and interest on the mortgage. So this is your mortgage payment, $12,900 per year. The second subtraction is $3,000. That's the annual home insurance policy premium and property taxes total. For your situation, you may have that included in your mortgage payment itself. So if that's the case, you could just include that in the mortgage amount and delete this line in your personal model. And then we're subtracting out an estimate of 15% in maintenance costs. It's kind of an industry practice here, but you may experience a bigger or smaller number. It kind of depends on if you're going to be doing the work yourself or if you're going to hire individuals to do the work for you. If you end up having to repair damages, if a tenant soils the carpet, or if you have plumbing issues or have to replace a hot water heater or a roof, this number can change a lot, to say the least. So looking at just these very basic subtractions in cash flow from your annual rental income, you're looking at minus $600 for the year in cash flow. On this slide, we're looking at the rent tax implications. So the first line here, the $18,000, that is once again the annual rent gross income that we anticipate receiving for this property. And then for the subtractions here, this is a little different than what you would experience from a cash flow side of things. For example, this first line, the minus $7,500, that's depreciation on your tax return. If you have a rental property, you can subtract from your gross rental income calculated amount of depreciation. The rules around calculating depreciation on a rental property are actually pretty complex. You want to contact a CPA or contact the IRS or go on irs.gov and read through their publication number 527. Some basic rules of thumb there are you just want to make sure that you're calculating the right basis to calculate what the total depreciation is. You want to make sure you're using the right life, as it's called, for calculating the depreciation. You want to make sure for the building you're subtracting the land value, and you also want to make sure that you're using the right depreciation methods. And if you check out the IRS pub, you'll see what's called MACRS, Modified Accelerated Cost Recovery System. That's generally used for rental situations. So in this scenario, I'm saying that's $7,500 for depreciation. The next few subtractions we saw in our assumptions, so the $2,700 for maintenance costs, the $3,000 for the home insurance and property taxes, and then you can also deduct generally on your tax return the amount of annual mortgage interest for the rental property. You'll want to amortize how much that is on Bankrate.com for the year you are within your mortgage. But at the end of the year, you'll also get a 1098 tax statement, and that'll tell you what the actual number was that you experienced. Or you could contact your lender and ask them what they estimate that number would be if you're building this model to try to make a decision on whether you want to even rent out your home. So after all those subtractions, in this scenario, we're saying that our annual net taxable income is actually a minus $5,200, and that means that your additional taxes on your tax return at the end of the year are going to be zero. There are rules around what you can do with that $5,200, so you'll once again want to check out irs.gov, and the publication number once again is 527. That'll talk a little bit around your scenario, give some examples on what you can do with that, whether you can subtract it from other sources of income that are taxable to you, or if you have to carry forward that minus number to future years where you do have a positive net income as it relates to just the rental property. So you'll want to check out the rules around that. On this slide, we're looking at the cash flow from the potential sale of this home. So this is saying that we're going to sell the home instead of rent it. And so the first line here was in our assumptions slide earlier. That's saying that the sale price we anticipate based on a CMA that was prepared by a realtor is $250,000, and then we're going to have to pay certain things out of pocket once we receive that $250,000 from the sale. The first would be, of course, paying off the current mortgage on the home, so that's the minus $200,000. And then I've also thrown in an estimate of 8% for other sales costs, which would be $20,000. This would include such things as realtor commissions. It would be the seller's portion of any property taxes that are outstanding. There could be, if you have an HOA, there could be a certain amount up or down for that. So this is just an estimate for you. It could be 6% for other sales costs. It could be 10%. It could be more. It could be less. This is just an estimate. So in this scenario, we're left with estimated net cash flow from the sale of this home of $30,000. On this slide, we're kind of comparing both cash flow scenarios. So on the top half, we're looking at the $30,000 in anticipated net cash flow from selling a home. And on the bottom, we're looking at the minus $600 in estimated cash flow for renting out this home. So it's kind of up to you in the end. In this scenario, it looks like if we're going to rent out the property with optimistic expectations, for example, full tenancy, that $18,000 in annual gross rental income, it looks like we're going to have almost assuredly a negative number for the year. On the sell side, we're looking at $30,000 that we may be able to achieve in a short time frame if the home sells quickly. So in the end, it's basically your own personal decision once you look at these numbers, but you also need to probably consider some qualitative considerations, such as the legal ramifications of being a landlord. There's many rules out there, and they're different by state generally, in terms of how you can, what you can and cannot say in advertisements for rental properties. You'll probably need an attorney to prepare or at least review a lease agreement that you've prepared. You want to make sure that you're abiding by any eviction regulations that you have in your specific state if need be. So there's definitely things to consider other than just the dollars of the situation as well. So we've reached the conclusion of the rent versus sell analysis that I prepared. If you have any questions on this analysis of this presentation, feel free to reach out to my wife, Jocelyn. You can reach her at jcrealtydenver@gmail.com. Feel free to also visit our website, www.jcrealtydenver.com, where we have some great buyer resources where you can search homes in the Denver area directly fed from the MLS. And you can also check out some of our seller resources that we have on that site as well. So thank you for spending time with us, and we hope to talk with you soon.